This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed's sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Wish you could become a morning person? You know the type, up before the sun, early morning runs, first one to the office with donuts and a smile. How do they do it? Easy. With the new Galaxy Watch 8, sleep tracking and personalized insights from Samsung Health help you improve so you can wake up to a whole new you. One who, dare I say it, skips the snooze? It's possible. Train your sleep with Galaxy Watch 8. Learn more at Samsung.com. Requires compatible Samsung Galaxy phone, Samsung Health app, and Samsung account.
Welcome back to The Bull, your personal finance podcast. Ladies and gentlemen, today just two simple words would be enough to introduce the episode you're about to hear. Cathie Wood. Cathie is probably the most famous woman in the entire global financial landscape, and without a doubt, the manager behind the most iconic active ETF ever created. Like all extraordinary figures, her work has often been polarizing. In 2020, she became a living legend when her flagship fund outperformed virtually every other equity fund, up more than 150% in just 12 months, thanks to visionary calls on companies like Tesla, Zoom, Coinbase, and many others that soared at exponential rates during that remarkable period. Then came a long winter, driven by rising interest rates, which sent the fund down over 80%, much like the Nasdaq during the dot-com bubble. But starting in 2023, a powerful recovery began, almost plus 200% since then and plus 50% year-to-date, bringing the fund's overall performance since inception to nearly 16% annualized. Since 2024, ARK's ETFs have also been available in UCITS versions, listed on the main European exchanges. With Cathie, we talked about the core principle behind her investments, technology-enabled disruptive innovation, as well as the key investment themes of the future, her unconventional mindset, her views on Bitcoin, and the approach she believes investors should adopt when looking at these sectors. But without further ado, here's my visionary conversation with the great Cathie Wood. Enjoy it! Cathie, welcome to my podcast, The Bull.
Oh, I'm happy to be here, and I love the title of your podcast.
Oh, thank you so much. It is supposed to be a somewhat optimistic one.
Yes. Very, very futuristic, I would say.
Yeah, that would be the idea. It all started as less than a side hustle. Then it has suddenly become my full-time job. It's a serendipitous story, let's say that.
Oh, that's wonderful. That's wonderful.
Cathie, I'm thrilled to have you here. It's an amazing opportunity for me to talk to you. You were mentioned several times in my podcast because it's not an overstatement to claim that you are one, if not even the most famous and influential woman in finance all around the world. So I'm very, very honored to have you with us.
Well, I'm thrilled to be here. I have just taken a trip throughout Europe. I didn't hit Italy this time, but we do regularly because I think Italy is very thematic in its investing style. And I think the investors in Italy are very tech-savvy. So it's always a pleasure to speak.
Please come visit us next time you travel to Europe.
Of course, yes.
Okay. As I said earlier, you are very well known among my audience. Therefore, there's no need for an introduction because your name truly speaks for itself. But please, walk us through ARK's history. Why did you decide back in 2014 to fund ARC, and what its mission, vision, and strategic view are?
Sure. So in 2014, I founded ARC for two reasons. One was to focus exclusively on technologically enabled disruptive innovation. And then the second one was to open source our research. So why only technologically enabled disruptive innovation? Well, I felt we were going to fulfill an unmet need. That is why anyone should start a business, only if there is an unmet need. And what we saw happening, really starting in the early 2000s during the tech and telecom bust, and then even more so after 0809, we saw a move in traditional financial markets, asset management, towards passive, and even within active investments towards benchmark sensitivity. So looking at the S&P 500, the NASDAQ, the MCSI world, looking at the weight and say, I'll have a little bit more of this, a little bit less of that, letting the index really govern the investing. And I felt it was really important given all of the technologies evolving. So the 5 major platforms: robotics, energy storage, AI, blockchain technology, and in the life science space, multi-omic sequencing. They involve 15 different technologies. The technologies are converging, and I didn't think enough research was being done on these opportunities, and therefore there was not enough investment in these opportunities. And I felt that we could fulfill an unmet need. But I also think from a competitive point of view, countries' competitive standing in the world, that we needed to allocate more capital to these areas in the public equity markets. Now, since then, we've started a venture fund. We started 3 years ago, and we see that kind of investing take place in the private world. But as the physical and the digital worlds meet, we're going to need the public markets to scale these opportunities.
Yeah, that's fascinating. Thank you. And how do you define technology-enabled disruptive innovation when it comes to picking a company and deciding, okay, that fits our vision?
Sure. Well, first of all, an innovation platform has to meet 3 criteria. One, it has to be technologically enabled, which means it follows a learning curve. And those learning curves are expressed through cost declines associated with efficiencies. And we've centered our research around something called Wright's Law. So Wright's Law is a relative of Moore's Law, which basically said twice the power at the same cost every 18 months to 2 years. Okay, Moore's Law is a function of time, every 18 months to 2 years. The semiconductor world followed that cadence beautifully for decades. But now it has hit up against the laws of physics, and Moore's Law is not working in the semiconductor world anymore. What is working is what we use for every technology. It's called Wright's Law. It is a relative of Moore's Law. It is not a function of time, it is a function of units. And I'll just quickly give you what the law says. For every cumulative doubling in the number of units produced by a given technology, costs decline by a consistent percentage rate. So for every cumulative doubling, 1 to 2, 2 to 4, 4 to 8, costs decline by a consistent percentage rate. So we need technologically enabled companies that are going to be following Wright's Law. And why do we need that? Costs come down, demand goes up as prices follow costs down. And then the second characteristic is that these technologies are going to cut across economic sectors. And so even in the multi-omic sequencing space in life sciences, many people think that's just about human health. No, it's not. It's about agriculture, crops, animals, and so forth, right? So scales across sectors. And if we're right on these technologies, they become very big opportunities. And really, in the early days, we're looking for a low base. The technology is just emerging. And certainly DNA sequencing is at a very low base, just for example. And then the third characteristic is that these innovation platforms serve as launching pads for more innovation. And an easy example there is, okay, now we have DNA sequencing. It used to cost $2.7 billion in the early 2000s to sequence one person's genome. Today, it costs $200. So you can see how deflationary the trend is, and therefore how explosive this is going to be. Why? Because if we can detect mutations, which are programming errors in our genome, and we get more and more of them as we age, well, now there's a new technology, CRISPR gene editing, that can reprogram the genome and cure disease. And that's not futuristic. That's happening now with sickle cell disease and beta thalassemia, a company called CRISPR Therapeutics. So those are the three characteristics that really, as we're doing our research and just asking questions, what is an autonomous vehicle? In 2014, when we started the company, what is that? Well, we learned. Tasha Keeney went out and consulted with academia, with futurists, with people who were dreaming about this new world, and learned very early on that the brains, or this central nervous system of an autonomous vehicle, was going to be a GPU. At a time when NVIDIA was being dismissed as nothing more than a PC gaming chip company, and PC sales were dropping at a double-digit rate. So we got into NVIDIA when it was less than $10 billion in market cap, and now it's trillions of dollars.
Yeah, that's unbelievable. Thank you so much for the definition and for this perspective built upon the Moore's law extended to different fields and across industries.
Right. And it's very pervasive
Yeah.
and very deflationary.
And I think that's going to be the big surprise in the next few years, how these deflationary trends in technology are going to permeate
The global economy and really cause surprising unit growth and surprisingly low inflation.
Yeah. Very often this year, you've mentioned those 5 big investment themes you're really passionate about. Could you please dive a little deeper into them?
Sure. And this would be the 5 platforms, just give you a little insight into each of them. Well, I think I mentioned the 5 platforms. What's interesting is the biggest ideas from our point of view are those that are harnessing more than one technology and are taking advantage of the convergence among technologies. So Tesla, we regularly feature as the poster child here. Elon Musk, in his master plans, if you go back and read them, he understood that technologies were going to converge. And he also understood that one of the most important competitive advantages would be in data, proprietary data. So think about, Tesla certainly has proprietary data on all the roads around the world. But he was thinking much more broadly. SpaceX has data on space that nobody else has. Neuralink has data on the human brain that nobody else has. X has data from, all kinds of people. And it is surprising to us. In 2014, when X was called Twitter, we never thought Twitter would be our most important social network, but it has become that because so many innovators are talking. There are a lot of others, but back in 2014, it was tweens, teens, and celebrities, and not so many innovators. And then we started using it and we saw, wait a minute, there are a lot of people talking about innovation. So he has all of that data as well. Tesla is the convergence of robotics, energy storage, and AI. Elon understood very early on that autonomous travel is where we were going. So autonomous vehicles are robots, and Tesla has 7 million robots roaming around the world right now. I have 2, a Y and a 3. Energy storage, because costs associated with electric drivetrains are continuing to fall, whereas gas-powered vehicles, the internal combustion engine, is very mature, and those costs are not falling anymore. We believe that robotaxis will be electric, and they'll be powered by AI. So there are 3 of the major innovation platforms today converging in the form of one company. And so what that means, if you can imagine, is each one of these platforms is following its own S-curve, slowly, then all at once, right? Slowly, then all at once. And now Tesla is really one S-curve feeding another S-curve, which now that taxi has been launched, we think is going to lead to explosive growth.
You consider robotaxi the ultimate AI project, don't you?
Yes, we think it is. We've called it the largest AI project on Earth. And Elon Musk liked that on X, so that was good. But
Elon
then
approved.
Even beyond the robotaxi market, and we have very little in our 2030 model for humanoid robots, but that market is going to be even bigger. And it is the convergence of the same 3 technologies: robotics, energy storage, and AI. It's just from a physical point of view, the actuators are really the complicating story, and getting the fingers, which are more like puppets, managed by actuators, getting them to work and thread a needle, that's more challenging. But we think it's going to be an opportunity 2 to 3 times larger than the robotaxi platform opportunity.
Is that the reason why you always say that if you had to pick only one stock forever, that would be Tesla?
Yes, it would. It would, because of not only robotaxis, but then humanoid robots, which extend the story dramatically for many, many years.
Cathie, you have an incredible ability to anticipate the future, almost as if you can see it unfolding before anyone else. And I really envy that. But when it comes to understanding finance, I come from a pretty traditional background. I got my MBA, and I was taught that the value of an asset is the discounted value of its future cash flows, very, very basic stuff. And the overarching paradigm in finance is the efficient market hypothesis in whatever form you look at it. Broadly speaking, prices are supposed to incorporate all available information, leaving little to no room to consistently beat the market. But obviously, your investment approach suggests that the market isn't really able to properly discount disruptive innovation. So the question is, how do you balance the traditional idea that prices are mostly right with the belief that there are still inefficiencies, or let's say opportunities that aren't fully priced in yet?
Okay, so first I have to tell you that I'm standing on the shoulders of our chief futurist, our directors of research, our analysts, and our research associates. So there's a lot of work that goes into this. But what's also very important about that is, in order to understand how big these opportunities are going to be, you have to define the opportunity correctly.
Yeah.
So just let's go back to Tesla. In 2014, Tesla directors of research in the traditional asset management world gave Tesla to the auto analyst. Now, the auto analyst was an expert at the internal combustion engine and human-driven cars, but knew nothing about robotics, energy storage, and AI.
Yeah.
We have set up our research department very differently from traditional research. Our research team's responsibilities are broken out not by sector, not by industry, not by sub-industry. Our analyst responsibilities are broken down by technology. And there are 15 different technologies out there involved in those 5 major platforms. And so we have 15 analysts focused on 15 different technologies collaborating because these technologies are converging. So we got Tesla right well before the traditional asset management world because they hadn't defined Tesla correctly. So I think that's very important. The other reason I think that the market is extremely inefficient, I think it's gotten more and more inefficient over the years, is because of this move towards benchmark-sensitive investing. And so if you put a benchmark at the center of your investment philosophy, then you are not really considering stocks that fall out of that benchmark. And guess what? Those are the stocks are associated with companies who are creating the new world. So that is why investing has become less efficient over time. And interestingly, yesterday I was on a call and an advisor said, yeah, I think that indexation is the equivalent of socialism. It's like socialism, and what we're doing is the opposite of that. We're trying to figure out how the world is going to work, not manage how it is working and redistribute among a few indexes, but actually go out there and see who's creating the new world, right? And what's so fascinating about this move towards passive and indexation is it has happened as the seeds of the seeds for everything that is happening now. They were planted in the 20 years that ended in the tech and telecom bubble. They've been germinating for 25, 30 years, and now they're beginning to flourish. So interestingly, in the late 90s, you had investors throwing money at the seeds. That did not end well. That ended badly. And now you have investors fearful of the future because the future doesn't fit into these benchmarks unless the benchmarks say that it does. And I'm happy to say some of our stocks are getting into benchmarks, but we're usually there 4 to 5 years earlier. And we assume that they will get into the benchmarks. But between the time we get in and the time they get into the benchmarks, there's a huge amount of misperformance if you're just waiting for an index to bless your portfolio.
Yeah. It's remarkable that it took so long for Tesla, for example, to be included in the S&P 500, given the rules Standard & Poor's applies for company inclusion. By the time it finally entered the index in 2020, it was already a massive company, so I perfectly get the point.
Yes, just one other thing I'd like to focus on here. We've talked a lot about sizing markets and the top-down part of our process. But your question really is about the bottom-up part of our process. Now, I came out of the bottom-up stock research, stock picking world. That's my entire history. I started managing money in 1990. And top-down investing was frowned upon. And therefore, we lost a lot of top-down research, which was too bad because we do need that perspective. But in terms of bottom-up stock research-driven investing, we have 6 metrics, 4 of which we score, very important to innovation. And some of them are more qualitative, some more quantitative. I'll just give you them very quickly. So the first one is management. So the people and the culture. Do we have a visionary management with a very strong point of view about the way the world is going to work, and really vision and willingness to stand up against short-term oriented shareholders who want their profits now, their dividends now, their share repurchases now, because it's so important to invest in these technologies. The second is moats, barriers to entry. Where is the barrier to entry? Today in AI, proprietary data is critical. Domain expertise is critical. Distribution is critical. And then execution, whereas other portfolio teams might be looking at operating margins to the decimal point, we are not. In fact, if a company says in a quarterly earnings report, you know what? We missed our operating margin guidance because we decided this opportunity is so important, we needed to invest more. Often a stock will go down 10, 20% on that one day. And if we are engaged with the company, have done our research, and like the direction they're going, we're happy they're investing more. So we will buy on a day like that. And then the fourth is product and service leadership. So there are a lot of services that provide market share. There are a lot of quarterly earning reports to help us piece the puzzle together. But there's also a lot of sentiment that we're getting on social media. That's real time. Any piece of research that we put out there, we get a lot of reactions, some positive, some negative. All are welcome because we actually don't want to be wrong. We're putting our research out there not when it's finished, but as it's evolving. And we want to catch mistakes we're making. So those are the four that we score. You're asking primarily about valuation, but before valuation, I'll go to thesis risk.
Yeah.
Thesis risk is what could go wrong? What could throw our investment thesis off? Very often, it's regulation or some government intervention. And so if we think there's a high probability of that, or if that's in effect, we'll get a lower position in the portfolio. Today in the U.S., deregulation is unbelievable under this new administration. So thesis risk has gone way down for innovation. So that's very important to understand. And then when it comes to valuation, many people, because we do put out so much top-down research, many people do not understand how exacting we are in our valuation analysis. So typically our portfolios, our stocks, each sell at a premium to the market multiple. Why? Because they're sacrificing short-term profitability, investing aggressively to capitalize on exponential, if not super exponential growth opportunities. That's a good thing. We have a 5-year investment time horizon. We make the assumption that that premium valuation is going to compress towards a market multiple over the next 5 years. And our analysts and portfolio teams have to believe that the revenue growth and margin expansion associated with each company in the portfolio is going to overwhelm the margin compression in order to deliver a minimum hurdle rate of return of 15% per year over the next 5 years. Now, I'm very happy to report that since inception, I know there's a lot of focus on our endpoint sensitivity around 2020 and 21, boom, bust. Yeah. But since inception, the compound annual rate of return on our flagship portfolio, ARKK, now this is the U.S.
More than 15, yeah.
Yes, it's roughly 16% now. And it's more for most other portfolios except for the multiomics revolution, which is about 3 or 4% now. It has been highly disadvantaged by what we believe is a complete misunderstanding of what's going to happen to healthcare as the convergences among technologies, sequencing technologies, AI, CRISPR gene editing, transforms healthcare completely. So that has held back the flagship. But now that, thanks to deregulation in the United States especially, is beginning to catch fire.
Wow, well said then. You mentioned earlier the roller coaster-like path ARK flagship fund went through, especially in 2020 and in the last couple of years. I remember back then, during the COVID time, that ARK was quite the only game in town. More than 150% growth only in 2020. Back then, ARK was deemed one of the greatest funds of all time. Then 2021 and 2022 came along with inflation, the spike in interest rates, and those suddenly became very difficult times. Now you're back on track with 3 amazing years starting in the second half of 2023. And in the last 12 months, the fund has grown some 80%, really impressive. But it's not an easy path for a typical investor to bear this kind of investment, this kind of volatility. In fact, a lot of people bought the fund at the top and sold it at the very worst time.
Yes, believe me. Those are some of the saddest moments of my career. Are seeing both sides of that, which are people chasing momentum. FOMO, not rebalancing. When a portfolio goes up 150%, and other portfolios are up maybe 20%, you rebalance towards the other portfolios. You don't put more in the one up 150%. And then at the bottom, you've held. You should have averaged down, but okay, you've held. And then it's just too much and you sell at the low. It is so painful for me to see that. And so we are much more active today telling people, rebalance. If you would like to sustain a 5% weight in truly disruptive innovation portfolios, which are volatile, then and it reaches 7.5% of your portfolio, rebalance back to 5%. That will give you the psychological wherewithal to, when the portfolio drops to 2.5% of your portfolio weighting, buy back up to 5%. That is a very successful strategy over time, and it is active investing more from the asset allocation point of view, but it is really important to manage exposures over time.
Yeah, definitely. ARK's portfolio is heavily tilted toward long-duration companies with high sensitivity to interest rates, as we all saw in 2022. There's a lot of debate now about what's going on in the future ahead about rates, if they will be higher for longer, etc. Could it be that a headwind for your portfolio?
Yes, I think this is because of what happened in 21, the fear of higher rates, and then 22, the reality of higher rates. A lot of people assumed and dismissed ARK as it's just inversely correlated to interest rates. Well, I can tell you over my career that is not true. I would say it's kind of random. So even in ARK's own life, in 2017 and 18, interest rates went up. Now they went up slowly and a measured rate and not 22-fold in 16 months' time. I mean, that was crazy. And 2017, huge outperformance. I someone told me the number, like 8,000 basis points or maybe more outperformance in 2017. And many people dismiss that because Bitcoin was a big part of the performance. But then in 2018, when Bitcoin was crashing, we outperformed again as interest rates continued up. The market went down and ARK went up. ARKK was up. So I think that is a very easy way to dismiss ARK, but that's because, it's a focus on a very extreme moment in history that I do not think will repeat. And the reason, while we might have another pandemic, hopefully not, but while we might, I don't think governments are going to throw money at it the way they did the last time, because that ended badly and everyone is still suffering from it. So I don't think that's going to happen again. So I would just tell you, as far as interest rates go, we're a random walk. And a value investor explained this to me one day. He and he's an investor in our fund. He kind of uses ARK as the closest to a venture capital fund in the public equity markets. And that's how he gets his venture exposure as a value investor. And he said, when interest rates go up, there should be much more pressure on mature growth companies and maybe value stocks. Then there should be on very rapidly growing companies that are transforming the world, because the growth rates are so surprising, usually relative to expectations. And that's why we're so focused on Wright's-law. It gives us a really good idea on how rapidly these technologies are going to evolve.
Yeah, that's really fascinating, because it's a different way to see finance valuations. Because the typical idea is value stocks equals less sensitivity to interest rates, while growth stocks, high sensitivity to interest rates, since you have to discount at higher rates the future cash flows. But it's not always that way, and maybe you have anticipated something that has changed in the market. As far as ultimate disruptors are concerned, Bitcoin is definitely one, which you mentioned earlier. You're a long-time advocate of Bitcoin. What does traditional finance fail to grasp about Bitcoin? Because if you ask anyone from academia or traditional asset management, they would tell you Bitcoin has no value because there's no cash flow to discount and so on and so forth. What's your view on the other side of this story?
You could say the same about gold, right? A commodity.
Yeah, definitely.
And Bitcoin is digital gold. I think its role as a store of value is now well understood. Bitcoin is backed by the largest computer network in the world. It is secured by the largest computer network in the world. And it is mathematically metered to top out at 21 million units. We're at nearly 20 million now. It will never go above 21 million. I doubt the core developers, who won't change anything. And many believe the network, it benefits from ossification. I don't exactly agree with that. They do need to keep up with, they do need to keep the network up, modernize it, and so forth. So if you look at the inflation rate of Bitcoin, the supply growth, right now it has dropped below the long-term supply growth of gold itself. It's somewhere in the 0.8 to 0.9% per year range. Gold long-term over time has been 1%, but with the recent rise above $4,000 per ounce, I guarantee you gold mines are working overtime to increase that 1% supply. They have every incentive to do so. That cannot happen with Bitcoin. It's not going to happen with Bitcoin. So we think that Bitcoin is really three revolutions in one, I would say. One is a technology revolution. It really started building the layer of the internet that developers in the early 90s, late 80s, early 90s never built. And that was because they didn't expect any financial services or commerce to take place on the internet. Back then, people were very suspicious of the internet, gambling, pornography, a lot of technology.
I remember.
Start out with those early adopters, right? And so never now we have currencies native to the internet. This is very good. It's going to bring huge efficiencies to financial services, which really suffer from a 2 to 4% tax on every transaction in the Western world. And in emerging markets, it can go up to 25 to 30% for remittances in Nigeria. So that is going to compress and introduce a lot of efficiencies into the financial world. Second, it is a global monetary system. So one of my mentors is a person named Art Laffer, famous for the Laffer curve, supply-side economics, Reaganomics. And he collaborated with us on our first white paper on Bitcoin in 2015, when it was only $250. Today, it's $125,000. And when we wrote the paper, so we wrote it, he edited it. And when he finished, he said, I have been waiting for this since the U.S. closed the gold window in 1971. And really, Bretton Woods ended completely, and monetary policy became unhinged, and inflation took off. So when he said that, I said, okay, then this sounds like a very big idea. I said, how big could this be, Art? And back then, it was worth less than $10 billion in total.
Yeah.
He said, well, how big is the U.S. monetary base? And back then, it was $4.5 trillion. And today, it's $7 trillion. And immediately, we knew we had a big idea. So we do believe it is the first global, private, no government oversight anywhere, no throat to choke, rules-based digital monetary system in history. That is a very big idea. And that is why I mentioned earlier, it is the most secure blockchain protocol out there. And then the third revolution is it's the first of its kind of a new asset class. Now, I think the last real asset class was in the 1600s, equities. Others would say no, real estate and other things. But so this is a new asset class. And we think that it will become a part of the asset allocation exercise of, every allocator, because it does not behave like other asset classes. Now, as more institutions get involved now, and regulatory changes are accelerating that shift, it will correlate maybe a little more highly to traditional assets.
Yep.
And in a risk-off period, the correlations go to 1 anyway. It almost doesn't matter. But it's still, even today, acts very differently over time than equities or bonds or commodities or real estate.
Before we part each other, I have an important question I care a lot about, which is if today you were to give just one piece of advice to the average 30-year-old investor, what would that be?
Okay, well, you're young, and so you can afford to take risks. And we're in a very exciting period in history to do just that. Now, consider the source. I would say that. But the other piece of advice is, and it goes back to the FOMO and then, buying high, selling low. I think averaging into investments is very important, but even more important, if you're doing it yourself and not relying on an advisor, make sure you understand what you're investing in and you have conviction, because that will carry you through the tough times and actually give you the fortitude to average down when you need to. And then again, as I said, when you get into a situation where one of your assets is up 150%, take profits along the way, again, so you will have that fortitude to average down when inevitably investing goes through cycles, and you'll want to average down average in and not average out. You don't want to sell out. You just want to rebalance over time if you really have high conviction in an investment. And, that's one reason we give our research away. We post our trades at the end of every day. We want our investors on the journey with us, and we want them to understand what we're doing and why we're doing it.
Wow, that's a timeless lesson. Cathie, thank you so much for being with us. It's been a remarkable conversation.
Thank you, Riccardo. Thank you very much for doing all the research you have done on us.
I hope to host you here in Italy very soon.
And I would love that too.
Bye-bye.
Okay, bye-bye.
And that's all, folks. I hope you enjoyed this episode and that it sparked your own visionary imagination. Of course, some of the ideas we discussed might resonate with you, while others might not. But what truly matters is understanding different approaches to investing so we can build the kind of critical awareness that guides our own decisions. That said, a very big thank you to Cathie Wood for joining us and taking us on this journey into the future. And thanks to all of you for flying with us today. As always, don't forget to follow The Bull and turn on notification on Spotify, Apple Podcast or wherever you are listening, and to subscribe to the YouTube channel. It really helps us grow and keep bringing you more extraordinary conversations with even more extraordinary guests. That's really all for this episode, and remember, we'll be back next Monday, not Sunday anymore. Starting October the 20th, The Bull shifts one day ahead in our schedule, but of course, we'll still be right here with you on The Bull, your personal finance podcast.